Stock still in bear market territory. Joining us now is Oppenheimer analyst Colin Rusch. He has a hold rating on Tesla. First, let's just talk about yesterday's move. Is it technical in nature? Was there some kind of fundamental basis for it, or just simply a stock that's been oversold that received a bit of a bounce on a little bit of good news?
I think it's more the latter than the other dynamics. I mean, the company is going through a bit of a product refresh here, and I think some of the discounting reports that were out there around pricing were oversold here, and I think people were digesting some of that. You know, you also see a stock move 20% like this one has, and a company that really is pioneering, important technology over the coming decades, and I think folks, just look at this and say, time to take a short-term trade on this or cover a short.
Makes sense. So you have a hold rating. The stock's basically flat over the last year or so. What do you think would be the catalyst to the upside or downside from here?
For us, it's really around a change in dynamics around the manufacturing margins and, incremental evidence around the ability to monetize subscription services or recurring revenue, whether it's on the insurance side, on the self-driving technology. But the stock this year has moved, in large part around the AI trade. And so what we're looking at on our end is that it's going to take a while for them to monetize some of that IP and the investments that they're making now. These are very complicated challenges. There's a variety of technologies that are getting pioneered right now, and as the company works through that, and we think they will be successful ultimately, there's going to be an investment cycle and lower margins for longer, and that's why we're staying on the sidelines. And so as we look at this company, it looks like it's kind of in hibernation mode, or not necessarily hibernation mode, but in a flat line here for a little while as the company works through the real productization and monetization of the technology investments that they're making.
And on the long-term side of things, for capacity, you note in your latest note that this is a company that receives IRA benefits. They're investing heavily to expand that. What kind of time projection are you looking at on that front to see things really ramp up in terms of capacity?
They are getting immediate benefit from those IRA provisions, so that's happening right now. I mean, the real core dynamic here around margins is the competitive dynamic, and the competition out of Asia is getting very aggressive around pricing, and the margins on the hardware here with the cars are going to be challenged for a little bit as the industry goes through a cost reduction effort to really break through and move into the mass market. That's not a short-term project. That's a multi-year project, and we think the company has, a significant cost advantage versus a lot of their peers, particularly Western OEMs, and certainly has worked through a lot of the ramp challenges that a lot of those Western OEMs are working through right now. And this is just a multi-year process. And so as we look at this, waiting for the consumer to rebound a little bit, rates to stabilize, and see that consistent sell-through and the ability to start raising prices, or at least raising margins for the company, which we think probably happens over the next 12 to 24 months, but it's just not the next 3 to 6 months.
Right. Well, we'll see how long this shift in momentum can really last. Shares up about 1.7% again today. Thank you, Colin. Appreciate it.